The Atlanta Story is a podcast highlighting Atlanta's most interesting creators, entrepreneurs, and builders. I'm Jon Birdsong with Atlanta Ventures, and in today's episode, we have co-founder of Gather Technologies, Nick Miller. Nick started Gather with his co-founder, Alex Lassiter, almost 9 years ago, but it didn't start out the way they imagined. After 3 pivots and on the verge of giving up, Nick and Alex forged ahead to build a company with over 100 employees before being acquired by Vista Equity. We talk about how to find product market fit, what lessons he learned along the way, and what's it like running a Vista-backed company. We hope you enjoy the show and subscribe to the Atlanta Story. Welcome, Nick Miller, to the Atlanta Story podcast. Thank you for being here.
Yeah, thanks for having me. I'm excited.
Yes, there's a lot to discuss today on your entrepreneurial journey and all of the steps and decisions you've made to build a great business, and to also share some of the insights on what it takes to build something substantial. So thanks again.
Of course.
Let's dive straight in. And you spent a few years at Bain and Company, consulting. And when you went to Bain, did you know you were always wanted to be an entrepreneur?
No, definitely not. So the context there is I actually studied philosophy and psychology undergrad, and pretty late in the game realized that I did not want to go into academics, which was always kind of like the plan I was thinking about. And so my senior year, beginning of my senior year, I scrambled to figure out what I was going to do, and management consulting seemed interesting. And so I just gave it a shot, was lucky enough to get the job at Bain. And so going into Bain, I just, I didn't know anything about business. I had no kind of background or context there. And so I kind of treated it as a 2-year MBA to figure out, to learn a lot about business and then figure out what I wanted to do from there. But I definitely didn't go into it thinking, I want to be an entrepreneur. I want to start a business coming out of this.
Right. So that MBA, you just wanted to learn about business in general.
Yeah. I mean, honestly, I had no idea what I was doing day one. So they were nice enough to take me on and educate me. And I think, it was kind of one of those moments where you have a plan A for what you want to do, and you decide you don't want to take plan A. And so plan B was going to Bain. And I just was looking for the right opportunity to figure out what to do next.
Yeah. So talk to us about that opportunity, right? When you were at Bain and for 2 years, when did the aha moment occur to you that you were like, this is not what I want to do for the rest of my life? I do think that I am passionate enough to put all the chips in one area and break off and go start a company. Like, walk us through that thought process.
Yeah, for sure. So Bain was by far the best first job I could have gotten out of college, and I'm super thankful for my time there. And I think, when you start any job, you go through this honeymoon phase for the first 3 to 6 months. And that was definitely true at Bain. The typical work week is you're essentially on the road Monday through Thursday at a client site. And so you're traveling a lot. It's away from Atlanta a lot. And I think that was the first part of the job that got pretty old pretty quickly. I just didn't love being on a plane Monday morning and Thursday evening. Beyond that, I think, I didn't necessarily find somebody in the senior ranks in the Atlanta office who I could point to and say, you have an amazing life and I want to be like you when I grow up.
Sure.
And I actually found that, I didn't see as many people who were senior at Bain who were super fulfilled from my perspective. And, I care a lot about family. I wanted to be able to be in Atlanta with my family, 10 years from when I was there. And I wanted to have freedom and independence. And I didn't feel like there was necessarily a path to accomplish all those things staying at Bain. And so that's when I started looking towards, all right, what else can I do? How do I gain freedom and independence? Starting a business and taking it to exit, if you're lucky enough to get there, would be a really fantastic way to do that and provide the ultimate freedom, over the next 30, 40 years for my career.
Yes. Yes. And so that freedom and independence led you to entrepreneurship. Talk to us about the actual day to day of making that transition, right? Were you researching markets and ideas at night? Were you um, were you interviewing entrepreneurs on how they did it? What are some things like from a real tactical perspective of like, I don't want to be this in 10 years. I do want to be this, and now I've got to start swooping the pendulum that way.
Yep. Yeah. So when I realized this was something I wanted to investigate further and potentially pursue, um, I actually did something called an externship at Bain, which is this really amazing program where they let you take 6 months. And typically people go to work for a private equity firm or go to work for a big corporate client of Bain's. And in this case, I connected with a former principal at Bain Capital Ventures, which is um, a different part of Bain that was focused on venture capital.
Sure.
And he was starting a daily deals company. And this is back in, I believe it was 2011. So this is like peak Groupon, living social mania. Scout Mob was crushing it in Atlanta.
Yeah.
And he was starting something in New York City. He was best friends with a Univision executive, and they felt like there was an opportunity to build something geared towards the Hispanic demographic in NYC.
Sure.
And so, I took a flyer on it. The first day I got there, I was employee number one, and it was the first day of the company's existence. I was there for about 5 months. It was an amazing experience. It taught me a few things that, I might consider doing in the future, but it actually taught me a lot about what not to do, because I didn't think it was necessarily a very well-run business. And then he ended up selling it the day before I was scheduled to fly back to Atlanta and get back to Bain. And so it was kind of cool to find this encapsulated journey. Yeah, it was wild. So I got to see end to end what a company looks like in 5 months. And that's when I got the bug. I was thinking the entire time, I can do this. I want to do this. This is super fun and rewarding. And so when I got back in, I think it was, late 2011, I started thinking, I've got to find a way to do this myself.
Sure. And did you save up money before you made the leap? And knowing that you were like, I need 12 months of runway, like, how did you prepare? Because there's so many listeners that listen to the Atlanta story who want to go start a company, right? But the steps to take are so difficult to just even make that leap, right? You've got to come up with an idea or find a market. You've got to save up. It's got to be the right timing, family wise. Like, there's just a lot of things. And help us walk through that kind of framework that you decided to go full leap into X market.
Yeah. I think calling it a framework would be giving me too much credit. I
know
think
Bain people love frameworks.
I know they do. And I'm kind of embarrassed that I was a Bain person and I didn't have a great framework, but I was lucky enough that it's much easier to do when you're early. I was in my early 20s. I didn't have a lot of commitments. I was living frugally. I was saving enough money already. And so I had a good kind of life foundation. Like, the timing was good, right? And I think beyond that, you think about the cost benefit or the risks of, I spend 1 to 2 years of my life trying to do something and it just doesn't work out. And I ultimately felt like if it didn't work out, there was a path to going back to getting an MBA or returning to Bain or doing something else, where I felt like I wasn't closing any doors by giving it a shot, if that makes sense.
Yep, totally.
And so in my mind, the risk was pretty low at that point in my life.
So then let's talk about the journey to gather from Bain, because it is one of the most fascinating product market fit stories out there, in my opinion.
Yeah. It was a pretty wild journey. It was also a longer journey than you might hope for, getting into entrepreneurship. But
can you give us the date of when you left Bain and then
sure,
and then go from there? Yeah.
All right. So I leave Bain with I found a co-founder and I leave together. His name's Alex Lassiter. He was at Bain with me. We left in, I believe, February 2012.
Okay.
And the initial idea is this company we were calling Frequenter, as in somebody who frequents local businesses. And the concept was, coming from Bain, a lot of what you do as an associate consultant there is you run surveys, collecting primary data, or you go find secondary data and you crunch it to deliver an analysis or an output for your client. Your client in this case is typically a Fortune 500, and they can afford all of the data collection, the data crunching, et cetera, et cetera. So we both felt like, why isn't there something out there that provides valuable data and analysis to local businesses? And this kind of harps back to the externship experience I had where I was working with local businesses, and I really love this space for a number of reasons. And so we kind of settled on this thesis of, why can't we do what we were doing for these large clients at Bain for smaller local businesses and provide them with valuable insights to run their business? And so it was called Frequenter. Generally the challenge was we had to sign up businesses and actually get the businesses to drive customer adoption in the form of filling out surveys at the end of their experience. And so, as an example, I live in Morningside. So down the street, Diesel, which is a bar restaurant, was one of our first clients. And, you can actually go today and you can still see the Frequenter stickers in their kind of checkout or receipt tabs that they have. Yeah, it's awesome. But you go dine at Diesel, and at the end of it, your waiter or waitress would say to you, hey, by the way, if you fill out the survey, we'll give you X% off on your next visit.
Yep.
And then the idea was we'd aggregate that data, read it back out to Diesel to tell them what they could be doing better as a business.
Sure.
Long story short, didn't totally work out, obviously.
Restaurants didn't want to. Yeah. What was the lesson?
No, I think restaurants wanted the information. I think the lesson is it is just so hard to drive consumer adoption, especially through a business. I mean, we were relying on your server to tell you about this and get you to pull out your phone and go to frequenter.com and enter a code. And even with 10% off your next experience, it's just so hard to drive adoption that way. And ultimately felt like it just wasn't compelling enough for the consumer, or frankly for the business, to drive adoption all around.
Yeah. And so during the Frequenter years, did y'all raise money, or was this still bootstrapped by you and Alex?
We raised $50,000 in maybe March or April from family and friends, like people who, they almost felt like it was a donation to us.
Sure.
If that makes sense.
Yeah.
But yeah, so we weren't paying ourselves. And in fact, we didn't pay ourselves all of 2012. We were just using our savings to kind of live day to day.
So what did you learn from Frequenter to the next evolution?
Yeah, so Frequenter evolved to be a two-way communication platform for businesses and their customers. And kind of had the same adoption issues. I'm just trying to remember, this is so long ago. We couldn't get businesses to pick it up in a way that was meaningful. And ultimately where we landed was, this is a nice to have. It's not a must have for a business, meaning it's not saving them money and it's not driving revenue. And so at the end of the day, a small business is busy with everything else they're doing. They just don't care enough if it's not doing one of those two things.
Yeah.
So that transitioned. I think now we're in summer 2012.
So fast. You're not spending a year. You're not spending a year on these things.
No. We got faster. You kind of pick up like, what are the signs that this isn't working out?
Yes.
And we actually we did this so many times that we coined a phrase internally, which started saying to one another, this isn't what success looks like. And like that was, at that point, that was this isn't going to work. We're going to move on to something else.
And is that a way to phrase like there wasn't enough authentic demand? Like what were those signs Was it the raised eyebrows of like, whoa, I need this? Or like what were the patterns that y'all were looking for to see that need to have?
I mean, you can just kind of feel that the metrics would be how many new businesses are you selling, and is there consistent usage on the application? But you can also just feel that there wasn't as much of a pull from the market to adopt or buy into what you were doing. And one of my mentors at the time, he was a guy who started Scout Mob, which was this amazingly successful application that had millions of users at one point. And his advice was something's got to feel easy. Like something in what you're doing needs to come easy, because if you're working really hard on every single part of the model, it's just not going to pick up fast enough and scale enough, or scale quickly enough per se.
Yeah, it's great advice.
Yeah. So we moved on from Frequenter. We launched quickly a product called Table Now. We'd found we enjoyed most working with restaurants. So we were focused on small business with Frequenter, and we moved exclusively to restaurants with Table Now. And the general theory was, in restaurants, restaurants are not really pricing what they're selling to demand, meaning the price of a meal or a reservation on a Friday night is the same on a Tuesday night. And obviously restaurants are significantly busier on Friday nights. And so the general concept was, can we build an application that gives restaurants more dynamic pricing power? And so we built this app. The first version of it was it's called Table Now. And essentially it was geared towards very busy dining times. And the idea was, you could be coming down the elevator 5:30 on a Friday, done with work, looking for, a great meal out. And you'd be able to hop on a Table Now and see what was available right then and there as a last minute table that over time we thought we could charge you a premium to book. And you'd be able to book it right then and there, go straight to the restaurant, enjoy a meal. What we didn't have a really awesome appreciation for, which we probably should have, was that all inventory at all restaurants was essentially controlled by OpenTable. And there weren't many companies with open APIs at the time. OpenTable was certainly not looking to share their inventory.
That data.
That was a moat for their business. So, it led to some, I would say, like comical scenarios for us working on the idea. I'll give you one example. We were working in a 2-story open office at the time, down on Memorial Drive at the Jane. And we had also brought on another co-founder who was technical at this point. His name's Tom Merrihew. So there were 3 of us. And because we couldn't access inventory data for the restaurants who had agreed to work with us for Table Now, we had to figure out a way to manually determine whether there were open tables at these restaurants. And so, long story short, we would run this Friday, Saturday, Sunday. Alex and I would be upstairs calling each restaurant, asking them, do you have a 2-top open? Do you have a 4-top open? Do you have a 6-top open? Logging it in Excel. And then on the consumer side, we had all our friends testing this app. So we would get a request for, hey, I'm looking for a table for 4 people. Tom would get that programmatically. And he would go to our spreadsheet, see what was available, and then manually return 3 results to the person who was using this on a mobile application. And that was another, like, this is not what success looks like moment.
Right.
We were working a little too hard.
That is, so walk us through then the evolution from there to Gather. I mean, was that, and more specifically, was that a month experiment, a 3-month experiment? Because you got to think right now, fatigue is starting to set in on just like, man, something's got to click here. Right.
Yep. Yeah. So that was, I think we picked up Table Now late summer, and that took us through, I would say, most of the rest of 2012. And, one thing that we were trying to come up with ideas to drive consumer adoption of Table Now. And one of the ideas that we came up with was, running very curated dinners at some of the restaurants that we were working with. We called them supper series, but
That's
it was basically, we'd sell tickets to a dinner. Again, this is all coming back to this idea of dynamic pricing, right? We wanted to put more pricing power in the hands of restaurants. And this is really a marketing play. So, we'd go to, I think the first one we did was at the Sound Table on Edgewood, which is an awesome place. And we'd go to the Sound Table and talk to the owner or the owner chef. And, we'd say, look, do you want to do something like totally unique, totally creative for one night or 2 nights or 3 nights? You can do exactly like whatever you want, you can do, which is music to most chefs' ears. And so we would go out and we'd sell tickets to this special dinner on their behalf.
Mm-hmm.
And the events were awesome. Like that was never going to be a business on its own because it's not scalable, but it was a lot of fun and we sold out basically everything we did. And so the interesting thing about doing that was most of the time when we would do those events, it would be on prime nights. So like a Friday or Saturday night. And so the restaurant would end up putting our group in their semi-private or private dining space. So this is not the main floor. This is, most restaurants that are full service actually have separate space that they sell to groups. And we didn't realize that at the time. So that was eye-opening in and of itself. And we also got to know the folks that ran these private dining or events at these restaurants. Mm-hmm. And we learned that actually this is a sneaky big part of a full service restaurant's business. It was typically 20 to 30% of top line revenue. It was higher margin because there was higher liquor spend typically, and the tickets were bigger. And, they were selling big chunks, like you'd sell 20 to 100 people at a time. And so it was really meaningful business. So that was all new to us. And we learned that through the supper series experience. And so when we kind of got to the same point that we got to with Frequenter with Table Now, which was, this is hard, like nothing's coming easy. And the market's not responding in the way that we would hope. We kind of turned to everything we learned about group dining or private dining in restaurants and said, hey, we know all these event coordinators across Atlanta now. We've seen that they're all using these massive pen and paper binders to manage this impactful business line for the restaurant. And it's not a great customer experience because typically you're signing a contract and you've got to actually print it out, sign it, scan it, and email it back. And so it felt like, hey, there's actually an opportunity to solve for both the customer side of this problem, which was, how do I know where to look if I'm trying to host a great event? Yep. And the restaurant side of the problem, which is we need to manage and grow this really impactful business line at our restaurant in a more deliberate and effective way.
And that started initiating the spidey senses of, this could be a need to have.
Yes, for sure. Yeah.
And so this is early 2013 now?
We're in early 2013. We also, to something you said earlier, there is fatigue setting in. At this point, we've all basically drained our bank accounts. So, were there ever conversations of giving up? Yeah. There was actually, I would say, 1 month-long period where we had a line of sight to, we've all got about 4 weeks until our respective bank accounts hit zero or close to zero. And we still weren't taking a salary. And I remember there was like a 2-week period where I know I was at least thinking about what I would do next. And I got the sense that Alex and Tom were having the same thoughts, if not being a little more active about it. Mm-hmm. And, luckily, we had cultivated a relationship with the first angel investor into Scout Mob. So we knew the Scout Mob guys really well. And, he actually came through during that 4-week period and wrote us a check into what would become a very modest seed funding round for the business. I think we ended up raising about 250K.
Wow.
And that was all on the basis of Gather, which was, again, the spidey sense of this is a real problem to be solved. We're going to go out and build it. And we went out and we got commitments from the restaurants that we had worked with for Table Now that if we built an event solution, that they would pay us for it. And we leveraged that into raising a small seed round.
And we're going to take a quick break here and share that this podcast is brought to you by Atlanta Ventures. If you are looking to start the next $300 million business out of Atlanta, check out the studio at atlantaventures.com. Okay, so let's talk about coming out of that depth of despair in terms of just entrepreneurial journey, and now you have a paying customer that is going to pay for something before you even build it, which is an amazing feeling,
Mm-hmm.
right?
Mm-hmm.
So corralled the troops, Alex, Tom, and said, let's give this another, 6 months. We've got 200 grand in the bank and go build this. Excitement's palpable. What did y'all build, and how did you know that the economics would make sense? Right. I mean, or so many entrepreneurs right now listening are saying, well, okay, you've got this kind of kernel of truth and need in the market, but how did you know you could turn it into a real business from the, unit economics perspective?
Yeah. Actually building with customers who are pre-committed is pretty amazing because you have a built-in feedback loop at that point. So, we were building alongside our customers or our future customers, and they were weighing in throughout the process on what they needed, how we would prioritize different features that we had ideas for within the application. So that part was fantastic. The challenge, the unit economics challenge in selling restaurant technology is how do you sell it in a cost-effective way, such that you can price the product for the market.
Sure.
Restaurants are fairly slim margin businesses. And as a result, they're very cost conscious. And even if you have the most amazing software in the world, which at the time I would have said OpenTable was a pretty fantastic piece of software for your average restaurant. You just heard a lot of chatter about the cost of OpenTable from restaurateurs in the Atlanta community for a whole bunch of different reasons. A lot of them were valid, but it's just long story short, restaurateurs are cost conscious. So if you have an amazing piece of software, you still need to price it to the market. And so if we fast forward a little bit, we had built Gather version, let's call it, 1.0. And we were selling it in kind of like an early days founder-led kind of way, which was we were just trying to network into everybody we could in the Atlanta market who might have a need for this piece of software. And that was going pretty well. And we looked at all the other successful restaurant technology businesses that have been built over the past 10 years at that point, and there weren't a ton. And we just asked, how did they sell their software? And almost all of them sold in person. So we felt like, all right, if this is the way to sell restaurant software, we've got to sell in person. So we were selling in Atlanta. And then we said to ourselves, well, we've got to prove that we can sell outside of Atlanta. Like we want to basically run an A/B test and make sure that this isn't just an effect of the fact that we know a ton of people at this point in this community. Yep. Let's go to another geography and see if we can sell there. So Alex and I were driving to Charleston every other week, and we would go, basically try to sell in Charleston. And a funny thing happened, which was, since we were selling in two markets, when we were in Charleston, we were still selling to folks, taking calls with folks that we were trying to get on to Gather in Atlanta and vice versa. So when we were in Atlanta, we were on the phone with folks in Charleston. And we actually found that it had zero effect on whether we could close the business. And so at that point, we kind of said to ourselves, all right, maybe we don't need to be in person. Maybe we can sell fully remote, which a lot of more forward-thinking software companies were doing inside sales at the time. It's not like a new concept.
Right.
but we hadn't seen it done in restaurant tech. But we thought, let's give this a shot and see if we can do it. And so, at that point, that kind of puts us at the end of 2013, and probably into 2014 a bit. And we decided at that point, let's just sell nationwide.
Yep. And y'all had some local angels at that point, right? So you raised the 200. Mm-hmm. Is that when you went out and raised out on the West Coast with Storm Ventures, which, great reputation, big names involved? Like, what did you have to prove to investors out West that this was something that they should be a part of?
Yeah. So it took a little more time for us to get to the point where we considered raising a round. So I think we started thinking about fundraising mid 2015. And from 2014 to then mid 2015, we were just hustling, selling new business.
What sort of revenue were y'all generating at that point?
Well, so at that point for a software as a service business, which is what Gather was, we knew like the big first milestone after product market fit is $1 million in annual recurring revenue, which is basically the value of all the contracts you have. And so we were like, up until then, we were just completely heads down, just pushing towards $1 million in ARR. That was the North Star. We were all focused on that. Everybody on the team knew that that's what we were pushing for. And so we were approaching it in mid 2015. Okay. And so at that point we thought, all right, now's the right time to go out and raise some more capital.
So 18 and we were also having 18 months ish to get there.
Yeah. Yes. Once we had product market fit, about 18 months. And we were having a conversation internally about whether we wanted to raise money, and ultimately felt like we were growing fast enough and we would be leaving growth on the table if we didn't raise more capital to grow our team.
Got it. And I'm sure the growth rate and things like that were all indicative of making sure that this was the right time. Got it.
Yep.
And so let's fast forward to Storm, and you're at $1 million in ARR to 2018. I mean, y'all were one of the fastest growing companies in Atlanta in terms of hiring people, scaling. You guys moved to Krog Street before it even got as popular it is today. Let's take a look at why did you decide Krog Street then? And if you were to go start another company, where would your HQ in Atlanta be today?
Yeah. So we after we raised the Series A from Storm, I think at the time we were in the Biltmore, so we were in Midtown, right near Georgia Tech's campus, and we decided to move to Krog. We love that area. I mean, it's fantastic, and it feels pretty authentic to what we were doing. In the industry we were in. I mean, you're basically surrounded by awesome restaurants when you're down on Krog Street. So for us, it felt like it resonated with the brand. A lot of our staff lived in that area at the time. And I think both Alex and I lived in the Highlands, so it was a quick drive down, and Tom was in Decatur, so it was easy to get to. But the main reason was it just resonated with what we were doing. We wanted to be close to restaurants. A lot of our clients were down there. And I think for attracting great talent, like you couldn't pick a better location, assuming that people lived close enough to where we were. So I think that was the one downside of being down there, is anybody who was in the northern part of Atlanta or outside the perimeter, it was a pretty tough commute for them.
Yeah, it was like a self-selecting location for sure.
Yeah.
So 2015, 16, 17, 18, and then you start having conversations with Vista Equity, which is the premier private PE shop in the world, right? And walk us through that process of just courting and the decision to take investment from them.
Yeah, for sure. I think this puts us at mid 2017. We were out starting to raise a Series B. At that point, we were 100% focused on going the traditional venture funding route.
Yep. Can you share the revenue numbers at that time?
Yeah. So we were at the end of 2015, we were at $1 million in ARR, and in early mid 2017, we were at about $5 million in ARR.
Wow.
Again, we felt like we had the growth trajectory and the numbers to go raise the round. And so we were talking to a lot of venture firms about coming in and helping us with the next stage of growth. And out of nowhere, I got a note from somebody at Vista. They were at the time actually starting a new fund, which was for the lower middle market with companies primarily with 5 to 30 million in revenue. And I sat on it for about 2 weeks, but I was intrigued enough that I ended up taking the call. And simultaneously, another private equity firm that we had known for a while at that point reached out and expressed some interest. And so, at that point, we were talking with some venture firms, and we were talking with Vista and another private equity firm.
Good to have that leverage as an entrepreneur.
Yeah. It was great. And, it actually, like, having a diverse set of options forces you to really think about what you want for the business going forward and what you want for yourself going forward. And so we were at a point basically where we had to make a decision. Do we go the venture route and sell a minority stake in the company, or do we go the private equity route and sell a majority stake in the business?
Got it. And the majority / Vista route won. And is that decision based off of just purely, personal plus best business outcomes? Like, how do you, Alex and Tom, sit down together and say, we've got this option, we've got this option. This option brings us this option brings us this, and we decide on X?
Yep. Yeah. There were a lot of different factors that went into it, but I would say the most important ones were, one was, how do we feel about this next phase or the next couple phases of growth for this business? And I think the one thing that always stuck out in the back of our minds was, how big is this market? And are we going to tap out at some point? And just to give some more context there, we weren't selling to restaurants. We were selling to full service restaurants that had events programs. And there was actually no good data on how many of those there are in the US. And so we kind of had to back in and guesstimate. And when we did that, we felt like between us and our largest competitors, we actually had a pretty big portion of the market covered with software already. And we started to run into competitors more.
Were your competitors, were they established, or were they still kind of coming up together in the market?
Actually, the two biggest competitors at the time had both been around for over 10 years.
Okay. So legacy products.
Yeah, I would say I would describe one of them as legacy. It was actually predominantly on-premise software.
Wow.
And then the other was cloud-based and actually, had a lot of similarities to Gather. They'd just been around a lot longer than we have.
Yeah.
So competition and market size was kind of, that led us to think, should we de-risk a little bit? The second factor was Alex had actually moved out of Atlanta for family reasons. He'd gone back to Raleigh, and he was still 100% committed to the business. It's just it changes the dynamic of things. Sure. When you have the whole team in Atlanta, and then one of the co-founders who's so important and meaningful to the team isn't there day to day. And so that was another factor. And then I think the third was, as we looked at the landscape of restaurant technology, we felt like there were a ton of point solutions that existed and thrived in the market at that point. And there were a lot of competitive point solutions as well. And by point solutions, I mean software that does one thing well. Uh, so, reservation software or waitlist software or event software or accounting software. And we felt like because of those dynamics, there was the market in general was ripe for consolidation. And if you don't have a deep-pocketed capital partner behind you, you can't be as aggressive or active in consolidating the market for technology as you would be otherwise. And so that was another point in the column of, if we go the private equity route, we're going to be able to kind of write our own story when it comes to consolidation.
So y'all decided on Vista. What is it like selling the majority of the business and still running it? Right? I mean,
Yeah.
Are you as motivated?
Yeah, you're definitely as motivated. But it's different, right?
Yeah.
And I think, when you sell part of your business, there are a lot of other life changes that come with that, that can be distracting at times. But I would say like that all kind of wears off 3 to 6 months in. And, ultimately we all still owned enough of the company at that point, even with Vista's involvement, that we were extremely motivated to keep growing the business.
And so many entrepreneurs talk about the Vista playbook, right? I mean, it's a process. It's a game plan that yields a certain level of scrupulousness around the efficiency of the business. What was it like pre-Vista and post-Vista from an operational perspective?
Yeah. So, Vista has, I think they're notorious in some really good ways and maybe some less good ways from entrepreneurs' perspectives around this playbook, like of having a playbook that they come in and they install in businesses that they acquire. And I think some of that is myth more than reality. And it's also born out of, if you think about the history of private equity, specifically related to software private equity, a lot of it up until this point was taking companies that were underperforming in their market and almost doing a turnaround where you'd come in and you might replace the entire team and you'd have to install all these tight operating procedures because the business just wasn't performing well at that point. And I think the story with what Vista has done more recently, and especially in the Endeavor Fund, is they find companies that are on a strong growth trajectory and they back them with capital. And there are always parts of businesses that can be doing better. And so a lot of the time at the board level is spent on those aspects of the company. And Vista provides this really awesome backdrop of both expertise in the form of these operating playbooks or people on the Vista team, and experience in the form of other operators in their network that you can lean on to essentially solve problems and scale your business. So, I would say the kind of operating procedures, like the myth of Vista comes in and installs 150 operating procedures in the business, is kind of overblown.
Sure. What so are there any things that as now that you look back, it's 2020, you guys did the deal in 2018?
Late 2017.
Late 2017. What are things that your key learnings that you had, or things that you would do differently if you were to redo the whole process?
Yeah. So I think in terms of the things I would do differently, I mean, I think one is as soon as the investment came in from Vista, we really tried to move as fast as humanly possible. And I think we tried to do a lot of things in parallel in the business that, looking back, I might have done in succession. So we were trying to ramp the sales team, optimize the sales process, fill out the executive team, and generally grow the business across the board all at the same time. And I think, looking back, I probably would have picked the top 3 things that we should be focused on in the business and really just focused on that. I think the other thing that I learned the hard way is hiring executives is really tough. And if you get it wrong, it's really not, it sets the business back at least 6 months. So I'll give you an example. So, and I think previously you asked me what it was like pre-Vista and post-Vista. So this is a good example. Pre-Vista, we did not have a CFO. We had one full-time sales or finance employee. And I was basically doing, most of what a CFO might do in a business that size. Post-Vista, that was the first hire that we really focused on filling. We frankly rushed the hire, and I didn't trust my gut. I made a bad hire. It just wasn't the right fit for the company at that stage. And, long story short, he left, or he was gone within about a year, and we had to go back and rehire that role. And the way you operate a business with a private equity sponsor, the CFO is an incredibly important role. And so it actually, all of what that role would have done in the company fell back to me. And so it took time away from doing other critical things in the business because I had to go back and rehire that role.
Yeah. Yeah. No, that's very insightful. Well, let's transition a little bit to how did you maintain your sanity as you're scaling, right? I mean, building a family, still obviously going out to dinners and having fun, but like, what did you do to maintain that degree of kind of mental health, physical health, while, this is late 20s, early 30s, and you're putting in 18-hour days?
Yep. Yeah. So, it's funny. I think so much of how you operate day to day personally just comes back to your life situation. So, from basically the beginning of the company through the beginning of 2019, my wife and I, we didn't have kids. We didn't have really any other commitments, and she was in medical residency for a lot of that time. And so we were both really heads down, and it gave me a lot of freedom to just focus on the business. Yeah. It was awesome. And then we had our first kid, a little boy, in January 2019. And you kind of have to relearn, this, you have to relearn and kind of reorient your life around family in a different way. And you have to fit your work around that. And so, I would say up until then, I was pretty lucky that I could really just go heads down on the company almost all the time. And so staying sane wasn't super hard. I mean, I would work out a little bit. Talking to other entrepreneurs who were in a similar situation was probably one of the best things that I did. But I was really happy to just like live, breathe the company.
Yep.
And then, once we had a kid, that changed. I had to block out hours of my life, to make sure that I had appropriate family time. And, at that point, then staying sane becomes being really thoughtful about how you set up your day and making sure you get in things like exercise, making sure you eat well, things like that.
So a couple more questions. I know we're coming up on some time. You, at the beginning of the interview, you talked about freedom and independence, right? Through the Gather experience, did you get what you envisioned in terms of freedom and independence? And was it worth it?
Yeah, definitely worth it. Would not change anything about the Gather experience. I mean, I think, one other thing I would add is it was about freedom and independence, but it was also about just having a really amazing and interesting life experience. And I think I checked that box for sure.
So follow-up question, obviously still young and you're a builder, you're a creator. What's ahead?
I don't know. We'll see. My wife and I are expecting a second in January. I know we were talking about that before we hit record. And so I'm giving myself space to really not do much until next let's call it April. And so, I could see myself starting another business. I could see myself working more on the investment side and supporting other entrepreneurs in the community. I'm trying to figure it out, but I'm not in a rush.
Sure. And then we always finish up the podcast with why Atlanta and what has Atlanta done for you?
Yeah, I didn't grow up in Atlanta. I'm from New Jersey, a suburb of New York City. And I never saw myself coming to Atlanta. I just ended up here because Bain recruited to their Atlanta office from UNC. And I have grown to really love the city and the community. And I think the interesting thing as it relates to Gather is I don't think we could have built the business the way we did if we were not in Atlanta. And it's because, your cost base of living is so much lower here. That, we could, I call it bootstrap plus until we got to our Series A, but, we basically spent $300,000 to build a business that had $1 million in annual recurring revenue. Certainly couldn't have done that in San Francisco or New York City. And the talent here is amazing. Georgia Tech is an incredible university that produces awesome engineering talent. And there's amazing sales talent in the city. And those two things are really what you need to run a software business. So I'm grateful and thankful that we found ourselves in Atlanta to build the company.
Well, Nick, thank you so much for being on the Atlanta Story podcast. We really appreciate your time today.
Of course. Thanks for having me.
This podcast is brought to you by Atlanta Ventures. It was co-produced by JC Lucas and Jon Birdsong. If you are looking to start the next $300 million business in Atlanta, check out the studio at atlantaventures.com and the companies we work with who've done it before. Thank you for listening to this episode. If you enjoyed it, please share it at your next coffee meeting or dinner greeting, rate it, and write a benevolent, eloquent review.